Good evening, and welcome to the financial report. Let us begin with Wall Street. The three major indices closed essentially flat on Friday, showing no significant directional breakout. The Nasdaq finished at 24,975.82, the S&P 500 at 7,411.98, and the Dow Jones at 51,947.25, with all changes effectively at 0%. Pre-market futures showed slight divergence, with Nasdaq futures down 0.11%, Dow futures up 0.43%, and S&P futures flat. This suggests the market lacks a clear direction, with funds waiting for macro catalysts later this week. On individual stocks, Nvidia closed at $206.84, up 0.02%, and Tesla at $313.03, up 0.53%, both with extremely limited movement. There were no verified significant unusual moves yesterday. Overall, the U.S. stock market is in a state of shrinking volume and sideways consolidation, digesting geopolitical policy uncertainties. The short-term direction depends on this week's FOMC meeting and the market reaction to the details of technology export controls. Now turning to the global macro picture. The yield on the 10-year U.S. Treasury note stood at 4.65%, down 0.64% for the day, marking a second consecutive decline. This suggests that market concerns about short-term liquidity tightening have eased somewhat, but yields remain high above 4.6%, and the bond market has not given a clear risk-on signal. The VIX Volatility Index was at 17.73, down 4.57% intraday, falling within the normal range of 15 to 25. This indicates that market sentiment is cautious rather than panicked, but it is far from entering the greed zone. The US dollar index DXY was at 101.42, up slightly by 0.21%, maintaining a range-bound and slightly weak pattern, putting limited pressure on emerging market assets. On commodities, WTI crude oil was at $84.28 per barrel, down 0.67%, and Brent crude at $90.78, down 1.4%, both weakening continuously. OPEC Plus production increase expectations combined with weak global PMI data form a double pressure, suggesting short-term downside risk for oil prices remains. Spot gold was at $4,084.30 per ounce, down slightly by 0.13%, consolidating at high levels with safe haven attributes still present but lacking new catalysts. To summarize, the current global market is characterized as cautiously waiting, with risk appetite neutral to slightly weak. Treasury yield stabilizing combined with the VIX retreating, but oil prices weakening and the dollar not breaking out, macro signals are offsetting each other, with funds waiting for clear catalysts. Looking at the external environment for Chinese assets. The onshore dollar-yuan exchange rate was at 6.7545, and the offshore rate at 6.7681, appreciating by 0.2% and 0.02% respectively. Overall, the yuan is relatively strong, recently fluctuating within the narrow range of 6.75 to 6.77, with limited depreciation pressure. A stable yuan exchange rate helps support expectations for northbound capital flows. On the trade tariff front, according to the latest Reuters report, the U.S. Commerce Department last week announced an expansion of export controls on AI chips and semiconductor manufacturing equipment to China, involving high-bandwidth memory and advanced photoresist technology, effective in August. In response, China's Ministry of Commerce immediately announced a new export license review mechanism for key minerals such as gallium, germanium, and antimony, escalating the countermeasures. There are currently no verified signs of substantive negotiations or easing between the two sides. For today's A-share market opening sentiment, we predict a higher open. The core basis is that last Friday, the A-share Chi-Next board surged 3.16%, the Shenzhen Component Index rose 2.72%, and the Shanghai Composite gained 1.16%, with market momentum continuing. Combined with no significant negative news from overseas markets and the yuan strengthening, buying sentiment should dominate at the open. For today's market direction, we believe the Shanghai Composite will likely oscillate with an upward bias, focusing on the resistance range of 3,880 to 3,900 points. The pattern of the Chi-Next board outperforming the main board is expected to continue, but it may rise and then pull back during the day, with a key resistance level at 3,620 points. In terms of sectors, we can focus on two directions today. First, the rare earth and key mineral sector. China's implementation of export license reviews for gallium and germanium directly benefits companies with reserves or smelting capacity in related minerals, and this sector is expected to see event-driven capital inflows today. Second, AI computing infrastructure, including data centers and advanced packaging. The tightening of U.S. controls strengthens expectations for domestic substitution, and funds will favor high-elasticity growth sectors. However, we need to remind everyone of the risks. The consumer electronics hardware OEM and Apple supply chain, which heavily rely on exports to the U.S., are clearly under pressure from the export control escalation and should be avoided today. Regarding northbound capital, the probability of net inflows today is relatively high. The yuan strength combined with stable overseas market sentiment and the Chi-Next board strength are favorable for foreign capital to increase holdings in A-share core assets. To conclude the outlook, the probability for today is 45% for an uptrend, 40% for consolidation, and 15% for a decline. In terms of operation, we recommend following the main themes, avoiding risk sectors, and waiting for clearer signals to emerge. Thank you for watching.